You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, where we share our experiences, the ups and the downs of what it's like to be a rules-based investor, and of course, where we also attempt to answer all of your questions. Good morning, Jerry. Good afternoon, Moritz. How are you guys doing this weekend?
Great, Niels. Good morning. Good afternoon, Jerry.
Hello, guys.
Hey, a pretty hectic week. I thought, at least on the political front, we had the G2 or the G20, I guess it's called, concluding last week after we recorded. And of course, there was the usual good intentions, and that seems to have lifted stocks this week. On the European side, however, they struggled to agree on a new leadership team. I think it took them like 3 days to find some new and surprising names. I guess one of them most relevant to us was Christine Lagarde as new head of the ECB. And of course, many of you listening today will know that she has been out saying in the past that sub-zero interest rates in Europe and Japan are net positives for the global economy, although she does warn that the side effects of unorthodox central bank policies should be closely monitored. And what I found interesting was that at the same time, we also saw that the head of the Bank for International Settlements, a guy called Augustin Carstens, he took a very different approach when they released their annual report. He said, we would stress that it is important to present some room for maneuver for more serious downturns. Monetary policy should be considered more as a backstop rather than a spearhead of a strategy to influence higher sustainable growth. So two completely different views here. And then, of course, on Friday, we had a pretty strong jobs report, which I think may have put a little bit of a dent, at least in some fixed income portfolios, but it didn't seem to be that bad. So, seems to be a continued, very confusing picture if you're an investor. Of course, we don't really worry about it since we only follow the price. But with all of that in mind, Moritz, how was your first week of Q3, July?
Good week. 4 good days, made money from the Lagarde effect. Along the bonds, 10-year yields, I think, are slightly less than minus 40. That's German yields, the Bunds. So we're all along those bonds and made money of that. Off the back of that. And then on Friday, yesterday, it was just the opposite where, we had the strong job reports, the non-farm payrolls in the US, and bonds sold off, equities down, gold down. So pretty much everything in the portfolio lost money. I lost 0.5% yesterday, but overall for the week, still up more than 2%. So good start into the third quarter of this year. And, some interesting movements there. Like, for instance, gold. Gold was performing so well, rising the last couple of weeks strongly. And then, of course, as trend follows would do, we increase our long positions. And just about when you're getting fully long, the thing's turning around. So, the never-ending story, but still like that position. And in general, the portfolio, I'm quite happy with the way that looks. Well diversified in terms of positions, longs and shorts in there. So, I'm looking forward to Q3.
Yeah, I'll echo your kind of weekly performance, very similar on our side, also very similar in terms of where we ended the week. A good start to the new quarter. I like the breadth, meaning of the portfolio. I think there are a lot of things that are in play. On our side, of course, in the fixed income markets, we saw some give back on the US side, but still making money for the week in Europe on the fixed income side. Equities, actually, Japan was the only area of the portfolio where equities were hurting. The rest still produced a little bit of a positive. The main winners for us really was the currencies. A little bit of gains in energies, a bit of gains in grains, but pretty broad-based. So I like the fact that there is a lot of movement right now in many of the markets. Also, when you just look at the outright moves for the week, we've certainly seen a lift in volatility on, I think, a classical CTA portfolio, although we're not really seeing a lot of volatility overall. I mean, the VIX is still trading at fairly low levels, so it's not like I think the whole world is concerned about increased volatility just yet. So yeah, that's how it all played out. What about you, Jerry? Single stocks, Bitcoin? What was happening this week?
Well, we've been warned not to talk too much about Bitcoin. So it's been really volatile, up and down, and crazy moves like gold. It's kind of funny. Gold sold off hard, rallied a lot. I don't know how many, 50 or more. Then it crashed again. So Bitcoin looks a little bit like gold, I guess. But it was good to see the dollar kind of try to stage a rebound towards the end of the week. But also I'm long a few now. Mexican peso could be considered in an uptrend, along with the Russian ruble. At least the Indian rupee futures made some new highs this week as well. So it's kind of good to have some longs and some shorts, and the shorts performing pretty good on the downside. Grains, soybeans kind of divorced from wheat and corn this week. Maybe started back into their downtrend. Short canola. I don't know if you guys trade canola, but that's the weakest of all the grains. Corn reminds me of gold a little bit. Goes up, goes down, goes back up. Pretty volatile market and directionless. I think, as I've said before, it's a profit. So use that profit as your backbone to just stay in the trade. And I've got a good entry with a good ATR associated with it. So I'm not going to get too uptight about this extreme movement in the open trade profit in this small trade. I'm just trying to ignore it, and hopefully these things will reemerge. There was something I read a few weeks ago, and we've heard this. It's like a little cliche, and that is something like, if the market doesn't act like you think it's supposed to act, then you could just go ahead and get out. And I was like, no, God, no. It never acts the way I think it's supposed to act. And these markets are always doing head fakes. You get really bullish one day and really happy with your position. The next day it could be down a lot. And that's the Italian bonds. They were up a lot and then down a lot. So I think follow your system, follow your exit, and you should have no expectation of, is the market behaving the way I think it should?
Yeah, nobody knows that. But interesting you mentioned the currencies, because we've been on that show saying we're long all the bonds, we're long the dollar against all of the other currencies. And same here. I now have a long position in the Japanese yen. I have a long position in, I think, the Canadian dollar and the Swiss franc, which is, the new feature of my portfolio, because for the past 9 months, this just hasn't been the case. And it's just been all about the dollar. So this has become more diversified now also.
Yeah, I mean, and as you talked about, Jerry, the importance of having rules to follow and all of that. I mean, I really truly believe that when you just see the landscape out there and you see all this noise coming through, from important places. I mean, let's not forget that you've got someone that Trump at the moment is trying to nominee for the Fed, who doesn't necessarily believe that the Fed should be setting the interest rate at all, and has been out saying that how can 12 people even be capable of doing so? I mean, this is pretty radical stuff, and I think it must be incredibly hard for fundamental investors to one, figure out what is really going on, and then two, to be sure that you can put on positions that will benefit from your own interpretation of this news flow. So in that sense, I think it's so much easier to just stick with your own system. Even though we saw a paper out this week from our friends at AQR, another brilliant short write-up from Cliff Asness and where he's essentially talks about something he's talked about before, which is, how hard it is to stick with something, even if you know in advance that it's going to be hard at some point. I think he goes back, 16, 18 months to a presentation he did where things were at the time, doing really well, but where he was telling people, warning people in advance that at some point you're going to find it really hard to stick with. And of course, they're going through that period right now, and he's reminding people as well as himself that this is part of the game, as hard as it may be when you go through that pain. It's nothing unusual, and the three of us were talking about it 6 months ago. I find it so ironic. 6 months ago everybody was talking again about the woes of trend following and how it doesn't work, and not only have trend followers as an industry had the best first half since 2008, but it's been relatively consistent, even though it hasn't been, trends in every single corner of the portfolio, but there's been enough trends to put in some decent performance for sure. Should we jump straight to something we didn't do last week? Because, of course, we were blessed with the attendance of Salem Abraham, which was a great conversation. Always good to listen to someone who's practicing trend following the way he does. But so we missed out on tweets. So maybe there are even more than usual, Jerry. I don't know, but we can jump in where you feel like.
Sure. It's a pretty good week for that. I ended up listening to a podcast, Flirting with Models, Corey Hofstein, and his guest was Wayne Himmelstein, and two of our guests we've had. And so those two were together, and I really liked this podcast. It was really interesting. Wayne is like he's a very interesting guy to read and listen to, and he's really smart, and he's almost a trend follower, but he has his own points of view, and I really like listening to him. But one of the things he said, and I tried to, I had to sort of keep rewinding and writing and typing to get. Hopefully, I got this kind of close. I think he liked these tweets when he saw them. But anyways, the first one is Corey is asking him about when systems stop working, and he goes, when will we know the strategy has stopped working? And Wayne says, at one point in time, he faced this idea and he said to himself, this thing is broken. And so he stopped trading it. And then a few years later, he did some back tests and found out that, oh my gosh, it came back. It's still working. And he said, I believed it was broken, but it went in and out of wide regimes. And he said, we never know is the true answer. So I thought that was pretty good.
If I can comment on that, Jerry, for a second, I think it brings up an interesting point, something that Patrick O'Shaughnessy on his podcast, Invest Like the Best, have been talking about in the past. And I think it's a very important point. He talks about the research graveyard. The way I've been talking about this for decades, I guess, is that trend following is like you have to find all the things that doesn't work until you find the things that work. But he then also adds to the point about, but we shouldn't necessarily completely disregard what didn't work at the time, because we should keep somehow monitoring this at, and I'm not entirely sure how frequently they look at it. But when you bring in new talent, a new researcher with a different viewpoint, who may not have read the same books as your current researchers, sometimes they can see things from a slightly different angle, and they can make more sense of some research that has been previously done. Of course, it's a super difficult question to answer. I mean, when has something stopped working, et cetera, et cetera. But I like the idea of this research graveyard. I actually think that, we shouldn't completely dismiss, for good, the things we find that doesn't work at the time, because who knows, maybe with a few tweaks, it can become a profitable approach.
I agree with that. And it doesn't even have to be tweaks, I think, Niels. To give you one example, one of the examples I'm looking at right now, I'm not going to be opening up too much about it, but there's a strategy that I've been looking at many, many years ago on cash equities, holding cash equities at a certain point in time during the day, overnight, things like this, right? And that's a strategy that you could get to work in the US because commissions in the US on cash equities are pretty low. You can trade for $1, right? Regardless of how many shares you trade. And there's a market on close facility and market on open, so you can get away, you can participate in the auctions, you don't have any slippage. Whereas if you wanted to trade that same strategy, say on Swiss stocks, on German stocks, on French stocks, Italian stocks, Australian stocks, the same kind of like characteristic is there, but the commissions are so much higher, for instance, in Germany or Switzerland, that there's just no chance that you could make any profit with that strategy. You'd just be losing money all the time, right? Now, the strategy is in the graveyard, therefore, for German stocks, but it just turns out that there's a new, broker firm coming up offering to trade for €1, right? So the thing is back on the table. And, not many people seem to be trading that. So it's an opportunity to get in until maybe it does become crowded, and then the effect goes away. But it's also things like this. The landscape changes, commissions change, the way markets operate change, and so I like the fact that you should keep them in the back of your head, and once in a while revisit them, and just press F9 on your computer and see how they work.
Absolutely.
We are laughing because we got a spreadsheet this week from a friend, and he just said, "Keep pushing F9, keep pushing F9."
Yeah, push F9 all the time.
Absolutely, that's true.
I trade a fair amount of the ADRs, the European and Chinese ADRs in my stock portfolio to get that international exposure that you lose when you got to get it back when you stop trading indexes. And then there's a fair amount of companies in the more liquid companies in the U.S. that they're not an ADR, for instance, but they're headquartered in another country. So that's just FYI. I think as everybody in the world works towards being more like me in trading single stocks, you can still get some of that diversification, right, from the different countries.
Absolutely. That was a great start for the tweets this week. What other things to do? Were there more from Wayne and Corey, or where else did your Twitter?
There's a couple. I tweeted some things from the AQR paper that I liked. Mm-hmm. They're the best, these papers, and it's encouraging and insightful to read. And then I also got some other little tidbits from an institutional investor article that was commenting on this paper. So this one is a little different, so we'll go with that one's. The AQR people are saying that one of Warren Buffett's success secrets is that he takes a lot of volatility. His magic skill is that despite some fairly horrific and non-too short relative and absolute return periods, he stuck with his style and his risk level like grim death. So I think that got a lot of interest because, people who read my Twitter page, they're very interested in being encouraged to keep at it and be disciplined, and how this is one of the keys to investing. And then I like this idea that maybe volatility for CTAs is going to be incredibly scrutinized. But, good old Uncle Warren, he sits there and he has these bad periods. It's really kind of humorous and funny because we know he comes back and keeps making lots of money. And I just think that's kind of funny that his secret to success and his magic skill is something that's kind of available to all of us.
Yeah, I think they were quoting something from their research that he had been underperforming the S&P by 76%. I mean, that's a handsome underperformance. Yet, of course, he rarely gets the same headlines in the press as we do. But there we are.
Cliff goes on to say in that article, in investing, perhaps more so than any other field, you truly have to learn to meet with triumph and disaster and treat those two imposters just as the same. We didn't think we were so great 16 months ago, and I don't think we stink now. So I think that's another good way of saying it. Your great periods, your bad periods, they're kind of imposters. We just have a tendency to get really happy or get really sad, and yet we're always going to be wrong by being overconfident or being overly pessimistic when we're following these systems and these trends that go in and out, and our performance goes in and out, and it really has nothing to do with anything. It's just testing us. So I think that was, I like that triumph and disaster are imposters.
I agree. Okay, so a small change in the programming. We simply lost Jerry. His audio could not keep up this weekend, so we will just continue, Moritz. And why don't we look at the Q&A? We'll jump over the tweets that Jerry will continue with next week, but let's go to the Q&A and see where that takes our discussion. First question is from James. James is wondering if we could guide him to any material or discussion on specific stop-loss management, the pros and the cons of these. I'm really looking for something that you think might be effective for allowing a trade/trend to breathe without giving the bulk of the returns back. Perhaps the Holy Grail, but an area that interests me. There was a mention about a white paper on random coin flipping, trade entries, and with tight risk management. I would like to know where I could get a copy of this if possible. I think actually this might have come from you, Moritz, but why don't we talk about the topic in any ways and see where we go?
Sure. So stop loss management. So I will have another look at finding that paper. It's what has been referenced here is the random entry coin tossing experiment by Tom Basso. There's information to be found there on Tom's website. If you just use Google Tom Basso, then you'll find that website. And there's a YouTube video on there which explains the experiment, and there may also be a link to the paper. But I'll see if I can find that paper, and then if I can, I'll make it available. Just one of the things in terms of stops. I mean, over the years, finding stops or finding out how to place stops and where to place them is that's a very important thing. I've migrated toward that becoming looser and looser and looser over time. I don't want the stops to be too tight. I don't want to be cut out of a position all too quickly and give up on the trend. And maybe I can just mention two books which I found immensely helpful when I was looking at those things many years ago, and they're both from Van Tharp. One is called The Definitive Guide to Position Sizing. That's a book that's a bit difficult to find these days, but if you make an effort, then I think it can be found. And the other was called, I think, Trade Your Way to Financial Freedom. A bit of a lengthy title, but there's a lot of information there, lots of really, really good information about, how to position size, how to, place stops, and, things like this. So if you're interested in learning more about this, those are the two books that I can really recommend on that.
And how's your own sort of stop-loss interpretation evolved in terms of techniques? I mean, you say you want to keep them a little bit looser per se, but are there any specific techniques that you have evolved into? I mean, classically, I guess most people are familiar with the classical kind of trailing stop that could be based on, X number of days low or something like that. We obviously know from the old turtle rule that it was 20-day in, right, 10-day out, and 40-day in and 20-day out. Mm-hmm. Is there anything you've found that
still extremely close to those techniques? Okay, Niels. There's an initial stop. The stops then start trailing after a while, and depending on how the markets move. But what I wanted to say is, my stop is a certain number of ATRs away from the entry level, but that ATR number has become larger over the years, and it used to be more narrow when I started out. But I don't like that much anymore, and I'd rather prefer to have the stops a bit farther away and have a looser fit to my positions.
Yeah, no, makes sense. I mean, I think that James, from my point of view, we at Dunn, we don't use stops. We manage our positions differently. So there's nothing there I can reference to. But in my experience, another way of looking at stops and what you're trying to achieve, of course, is to give trades a little bit more breathing room, but you don't want to give up too much of your open profit, in the end. So one thing that I was involved with a number of years back, we were using different types of stops. So the way that Moritz just described it would certainly be one of them. But another stop would be something that was somewhat time sensitive. And what we did was we allowed the stop to be wider in the beginning of the trend. And then as the trend went on in time, it automatically would tighten itself. So that's another way of doing so, because, and there's no perfect answer here, of course, but we all know that the longer the trend, at some point you could say the closer it is to coming to an end. And so having something that tightens it up a little bit, as it matures, might work. I mean, you obviously have to test this. But the idea would be to say you could use a few different types of stops. And then each day you would just pick the one that is closest to where the current price is. That's certainly one approach. It doesn't have to be a stop that's only based on one specific set of rules. In my opinion, you can have a few different ones in the background and then choose the one that is closest to the price, for example.
I once experimented with those time stops, and the idea, I understand the rationale behind that. You say the longer the trend has been going on, the closer it may be to its end. And so I looked at that, I tested that, and I stepped away from it because I had a problem with sample size on that one. If I forced the time stop to come in too often, like if I really wanted to have a large sample so that it's meaningful for that time stop to really be in action, then it deteriorated the performance of my system. And I could only get an improvement of the system, of the results, if I had the time stop only be effective, 10 or 15 or 20 times or something like that. So, and then every time you have this, it's not a reliable sample. So I haven't found an answer on that one, but that is not to say that there's a way to figure this out.
Exactly. One have to go and do their own research
Yes.
into that. This is more like brainstorming a little bit for James here. Next question is from Brian. And Brian starts out with some very kind words about the show, which is great. We appreciate that. My question is, what site or program would you recommend for backtesting? I've been trend following since 2009. But I have not spent any time on backtesting. My system works pretty well, but would like a good way to test it. Thanks for any info you can share. So, Moritz, anything that springs to mind that Brian might be able to look at?
The easy start is Excel, as always, right? And another thing that I really used a lot and which I still like is TradeStation. With easy language, scripting language, relatively easy to learn and then use. Also in a portfolio of markets, for trend following, all of that works with TradeStation. So that could be one alternative. But, in this day and age with powerful computers and Excel, if you have a good data source, be it CSI or whatever you're using, Excel can do it. And it does have advantages because, you can see what you're doing there. You can see the results. You can do the stats. Just a great tool to work with.
What's the pitfalls of Excel? Do you think? I mean, I'm not a sort of an Excel expert,
not,
right?
Right. It's not a programming language that is easily, not like in Python or R, where you can specify a ton of parameters and then quickly change them and rerun the entire thing. It's a bit more, strict in that regard, and that you have to put in the data, and the data is in a certain order, and so it's not as dynamic, right? Once you've worked with it, and once you've put the data in and you created that spreadsheet, it kind of like exists in that shape and form, and you have to work with that, and it's not that easily to modify and adapt. Yeah. And programming language, that is what a programming language is doing. You change a parameter and you run the thing again. But again, if you have already an idea, or you just want to play around and test some early things, Excel is great. And once you've found it, once you've found the system that you really like and want to implement that in practice, it can be done with Excel. I'm not saying that's impossible to do, but if you've really found it, maybe then you want to convert that into another system, Python, for instance, and make that your operational system on a day-to-day basis.
Yeah, no, absolutely. I mean, in my own experience, Brian, I would say often the default ends up, finding someone that can program these things to make a really serious attempt on the backtesting side. But I completely agree with Moritz that with Excel you can do a lot. Clearly, you have software such as TradeStation. And although I have not used it myself, but then there's another software which I don't know if it's how updated it is still, but there was a piece of software called Trading Blocks some time ago that also looked like a tool that could be used for backtesting. So anyways, I hope that helps a little bit, Brian, but unfortunately often with these things, if you want to do a really thorough job in terms of backtesting, it really requires some level of skill set in terms of programming, but hopefully Excel can be a good start. Paul has a, I'm not even sure if it's a question or a comment, but I'm happy to share it. It refers to a question that we got from Bruno a little while ago, end of June. Paul follows up he said, everything you said to Bruno made a lot of sense. I would just add a little tidbit, which is part of the answer you gave to my question a few weeks ago, which I found really useful. That is, diversifying is not only about diversifying asset classes, which is the normal way investors typically think about diversification, but also can be about diversifying the look-back period. If Bruno did backtesting with different time periods, he no doubt found that the longer backtest times had higher overall returns, which is hard to pass up, but the larger drawdowns, which is emotionally difficult when it happens. Why not split between multiple time periods? The shorter ones will not provide the best performance, but as long as they are profitable and by taking some money off the table, it may make it easier to hang in there with a longer time period when going through the drawdown. But trade both systems systematically. I mean, I completely agree. I think both Moritz and I would say that, yeah, I mean, diversification, part of that is, of course, diversifying your look-back period. Now, what we found on our side is that we actually allow our model to look at time frames that are relatively short up until relatively long time frames. And we have a process that automatically selects the specific time length or look-back periods that we want to trade live. It's an automatic process, which we've been using for the past 13 years. And it allows the model to recalibrate itself to changes in market structure as and when they occur. Now, of course, it doesn't change the look-back periods that often. And of course, also, it never selects anything in the shorter term space or time space because, as you suggest, Paul, they tend not to be as profitable as the longer term time frames. I mean, I think it's interesting about this question because I think a lot of trend followers have ended up in the last decade or so becoming a bit more long term. I know that Jerry talks about it. with us, because it's an automated process, it has certainly occurred as well. But I don't follow it that closely. What's been your experience, Moritz, in terms of your own look back periods? Have they changed a lot in the last 10 years or so?
Yeah, I mentioned that before. It's like Jerry, it's become longer term. This is just working better. And the shorter term or medium term, short term time frames that used to work back in the days, especially back in, when Jerry started out, they are no longer as effective. But as we've said before, there is a, research graveyard, and those systems exist. And I think it's very interesting to rerun them periodically and see how they're coping and how they're keeping up with those markets. And I've also said on that show that I haven't given up on them completely, right? So there is a space for those type of timeframes in my portfolio. And I completely agree that diversification across different timeframes, or across different systems, if you like, if you say, it's a new system, if it's trading on a new time frame. But this is very important. And, I don't want to just be trading one long-term window. I want to trade a combination of things, of course, with right now concentration around the longer term end of things, but there's medium-term exposure in there. There's some shorter-term exposure in there. And as we have seen last year, the short-term systems have had the best performance, and the longer-term timeframes, they really didn't work, right? Now, it didn't make a great year, but, I was glad to have had some of the short-term systems in the portfolio, even though they didn't, swing the portfolio around, but they helped. And that's just so much easier than to live through difficult times if you have that diversification.
Yeah, completely agree. And we actually did a study at the beginning of this year to look at timeframes specifically. We went back 28 years, so 1990 through 2018, to look at what would the optimal look back period have been for each year for a trend following system like we use. And it was really surprising to me, or enlightening to me, to see how different one year could be from another. I mean, you could literally have one year where the best time frame was 240 days, and the next year the best time frame was 40 days. I mean, it literally is that different. So and of course we never know this in advance. I wish we did, but we don't. So the key thing is to find something that can deal with these changes well. And I think that's probably why most people tend to be in the longer term time frame. And of course, another reason is, of course, that if you are short term, your trading volume increases a lot, and therefore it limits the capacity. And for sure, there are managers that would rather trade more money and then become a little bit long term. So that influences also the decision. But great question. Thanks very much. James is back with another question. He did actually send it in before, but it's came in and as a follow-up a little bit to the first question about diversification. So he says, another question I had for all of you for the CTA strategies: asset diversification, signal diversification, process diversification. Do you believe there is an optimal level, i.e., is there a point where too much diversification impacts the overall return profile? It's certainly a point that's come up before in our space. I mean, when does diversification become diversification, I think is how it's sometimes phrased. And there probably is a level. I mean, I'll be interested to hear what you say, Moritz. But in my view, I think one of the challenges for us as managers is really not making our systems too complex, meaning there are so many things we can do. And in theory, it might look like it's going to improve our programs. But in reality, when you put all this complexity together, you end up with something that is not as robust, quote unquote robust, more simple. And I know from our conversation with Corey, he talked about how making things too simple can be making it fragile, but also making things too complicating can making it fragile. And I think that's very true. And I really feel that sometimes we're trying to make things a little bit too fancy, because I think to a large extent that makes for a good story, and stories, they sell without a doubt. And I think that's something we have to stay away from. I mean, we should stick with what we believe is the best strategy, even if it's not the most complex and sexy story. But also would say that I think that's the hard part of what we do, is to take something that is or could be made complex and distill it down to something that is simpler, but where you have a much greater chance of it working through many different environments. I mean, I've quoted this before, but I think it's an interesting fact, at least. And that is that there are so many of these strategies that have been accused of not doing as well in the last 10 years compared to what they were doing 20 years ago, 30 years ago, et cetera, et cetera. But when we do the research on our side, we actually don't see that. We see the same performance in the last 5-6 years as we have done in the previous 30 plus years. And I think that is where you try and strike the balance between making something that is definitely not super simple, but it's also not so complex that some kind of small change in the market structure will completely throw it off course, so to speak. What's your thoughts about these things, Moritz?
Yeah, I have a few thoughts on that. Well, first of all, I just love the benefits of diversification. And in terms of complexity, so say I had a portfolio that's trading 70 markets, right? All in the same way, long and short, they're all treated in the same way. Now, if I'm adding an additional market or 10 additional markets to that portfolio, so the 70 becomes now 80, to me, that is not an increase in complexity. That's now just a larger portfolio that's doing exactly the same thing as before. If I added a different time frame, a new time frame, say I'm trading 10 time frames, I'm now trading 11, right? Or I'm trading 20, I'm now trading 21. Again, to me, that is not complexity. That is just a part of the system. I put it in, it's run in a systematic way, just in the same way as all the other parts of the system. Again, to me, that's not complexity, but it yields diversification, right? And I fail to understand that, people sometimes, I hear that, well, it's not worth doing that because it's not moving the needle. And we all know that after you've added the 15th market or the 20th market or, the nth market, the extra benefit you get from the next market is diminishing. And statistically, that's correct, right? But why, even if the benefit is small, I have nothing to, just throw away. If that benefit is small, but it doesn't cost me really a lot of effort to put it into the system. So I still want to have it, right? And it's there, so I take it. So I'm a big fan of that. I want to trade as many different markets, as many independent systems, independent markets as I possibly can, but in the same way, right? If I didn't trade them in the same way, if I traded wheat in a different way than Bitcoin, right, then that would add complexity to my system because I'm essentially then doing two different things, within one system. That's not what I want to do. But other than that, just, put them all in there. It doesn't really bother me. And I'm happy if I can do it.
No, I mean, for things like that, I generally agree. I think when I talk about complexity, I think if you put in too many rules that kind of has to be lived up to, triggered, whatever we call it, I think that's where the complexity comes in. Because I think what people try to do is they come up with these extra small rules to avoid the false signals, right? So, if I just added this and I just added that, then it wouldn't have taken all these bad trades. that's where I find sometimes you might fool yourself a bit. But I like
I
what you
agree
said
with that.
about,
And then
yeah.
maybe it becomes a storytelling exercise where managers say, well, I have this super special sauce and this special element in my system, which is so great. And then it's just kind of like the marketing side of thing. But I think Jerry has a tweet out there, or it used to be his pinned tweet, which just says, Chesapeake, if you don't want to be told the story, right? And in essence, this is what we're just talking about. It doesn't have to be overly complex. When what we want to do as trend followers is not per se complex. We're following trends. Of course, there's different ways of doing that, but it doesn't have to be super, super duper complex.
Unfortunately, most people do want a story, Moritz.
Yeah, I know that. I know.
So that's,
of course,
that's
you have to talk
our,
about that.
that is just how the world works.
Yes.
But anyways, we had a nice little comment from Mike, and maybe I touched upon this last week. I can't remember because it's already been a week. But Mike just said, trend following in alpha architect, wealth of common sense, and invest like the best, all in the same week. Good luck getting this week's episode under 90 minutes. I think what Mike was saying was that there was a couple of articles, and I made a little bit of a comment on it, but there's recently been a couple of articles out from some really well-known Fin Tweets guys and people that I think we all have a lot of respect for. And they were doing their analysis on trend following and why they didn't think necessarily it was better than long only or whatever. But I think this was relating specifically to trend following on stocks. And as I think I mentioned last week, I did my longest tweet ever as a response to these articles because I realized that you can combine tweets so you get more characters, which is great. But anyways, my point that I just raised was that it's fine to talk about trend following per se, even when you talk about trend following stocks only. But in my opinion, trend following was not invented for just trading stocks. In fact, stock equity futures were not even invented as a market when the pioneers of trend following got started. They got started trading commodities, and where you can get a lot of diversification. Because I think the secret sauce to trend following is the diversification, which we just talked about. And so when people show me analysis about why it's not necessarily producing the same returns as long only in equities, but they call it trend following, I kind of get the feeling that they are missing the point a little bit. I understand if they talk about momentum as a factor. I think you can certainly talk about momentum as a factor like you can on value when it comes to equities as a standalone sector. But for me, trend following really has to incorporate the fully diversified, or at least a somewhat diversified portfolio to be meaningful. And therefore, I wasn't too concerned that these guys didn't think that trend following on equities only was quite as successful as even though, I mean, of course, their analysis shows that your drawdowns get lower and all of that good stuff, which can be useful for an investor, of course. But you also lose something out, or you lose out on something, and that is the big turns when equities just suddenly start to rise quickly, and you still find yourself short because you're following the quote unquote downtrend until you get long again. You lose too much, really. And that's something we can relate to on our side. I mean, if we just look at our equity profit and loss for the past 10 years, then there would definitely have been long periods of time where the equity part of the portfolio didn't do so well, where it was other markets doing the heavy lifting. Like this year, it's fixed income doing the heavy lifting, which means that there are sectors that are not making money and maybe have not made money for a few years. And that's the beauty of trend following. The way I view trend following, and that is you have a diversified portfolio. There is always going to be a few trends somewhere when you have all these markets that you trade. So that's that, so to you, Mike, I mean, thanks for the heads up on the articles. I had seen them, and maybe you did as well, Moritz, and maybe you think something completely different to what I just said, but I just wanted to acknowledge Mike for his comment.
I think exactly the same, and had the same thoughts. I really like the content that Wes Gray from Alpha Architect produces. Just that article on trend following, just focusing and zeroing in on equities only. I thought, well, that's not the way we should really do that, right? I mean, it's a portfolio of things. Equities play a role, as do commodities, currencies, and bonds, and Bitcoin, and whatever you have in there. But it should not just be only equities. And this, just like you said, Niels, when it all started out, there wasn't even a financial equity index future available, right? It was corn and wheat, and I'm not sure which one was the first one, but I guess one of those two. And so, yeah, I completely agree with what you said.
And actually, that leads me to think that maybe we need to do more as an industry to try and distinguish that, because there are books out there and people talking about you can just do trend following as a concept, and you can just apply it to equities if you want to. But I think they leave out the warning sign, the health warning about doing it in a narrow asset class. Because of course, as we know, I mean, equities to a large extent can be highly correlated. So there's no internal, at least not the same amount of internal diversification as you would get if you traded, say, lean hogs and the S&P. I mean, there's a lot more diversification there. So maybe we need to do a better job of telling people, well, if you talk about momentum on equities, that's fine, but that's not trend following. And I'm not so sure I see that debate out there. So anyways, thanks so much, Mike, for that. Now, the last question is from our good friend Sam. Unfortunately, it is probably a question for Jerry, and since we lost his audio today, we may have to come back to this. But let's see where we go. Maybe you have some views on this, Moritz. Sam goes on to say, in the past, Jerry has said, soon after the turtle program ended, he realized he needed to take his time frame from 20 to 40 days and lengthen it by maybe 5 to 10x. What evidence or experience would lead to this realization? Obviously, becoming unprofitable might be one, but we tend to look at other metrics. Would it be an increase in trade volume relative to the past shorter trade duration, lower win percentage, noise over volatility, increase, etc.? The realization is very profound and critical, so understanding a bit more of the underlying factors would be helpful. While I use Jerry as an example, I think you can all contribute on this. Great question, Sam, as always. Moritz, I think we touched upon this a little bit, but do you want to give a few specific comments to Sam as to what may trigger a realization that our time frame should increase?
Yeah, I'm looking forward also to hearing Jerry's answers on that next week. But it is, in essence, a deterioration of trade stats, right? Maybe slippage, signal frequency, win rates, average loss, average gain, all of that over a longer time frame. Obviously, you don't want to be jumping to conclusions just because you see your trade stats getting weaker over a month, 2 or 3. But for a certain time period, a longer time span, if you see a continuous degradation in those trade stats, then you may want to look at that time frame. And as far as I'm concerned, I mean, it's not just been one of those shorter term time frames that stopped working. It's essentially all of the shorter term time frames that started to weaken in terms of quality. So there was an evidence there, a piece of evidence across time frames, 20 days, 25 days, 30 days, 40 days, all of that, right? And they all weakened. And so it suggested that there's something there, there's something in the market that just causes those time frames to no longer work as well. And we can all speculate as to what that is. Participation, crowding, electronic markets. Who knows what the final answer on that is, right? But the fact is, it's no longer working as well as it did before, right? Whereas the medium and longer term time frames, they continue to work. So that is, after observing that for, a longer period of time, I've made that shift. But it's not like I'm not just looking at one thing. I'm not just looking at what is the average gain or the average loss of that one time frame. There's a combination of things, many different statistics that I want to have a look at before making those decisions.
Yeah, that makes sense. And yes, no, I too look forward to hearing Jerry's answer, because I think we touched upon this with him a few weeks ago, or maybe even last week with Salem. And I don't think we necessarily, or at least I can't remember the answer. So we'll come back to that next week when we have Jerry back on again. I thought that was the last question, by the way, this week. Thanks to all of you. And for those of you who have a question that you want us to try and answer, just send your question to info@toptradersunplugged.com. Then we will do our very best to give you some feedback. Now, why don't I run through performance so far this month, this year, and then we think about anything else we want to bring up in this slightly unusual episode where we lost Jerry halfway, so to speak. But anyways, as of Thursday evening, which was July 4th, of course, so happy Independence Day to those of you who reside in the US. The BTOP 50 index off to a great start, 2.75 up for the month, up 8.11 for the year. SocGen CTA index, same picture, up 2.62% for the month, up 7.46 for the year. The trend index on fire, +4 for the month, +11.73 for the year. SocGen short-term traders index up 0.68 for the month, now up almost 1% for the year. And the bridge alternatives index up 2.86 for the month, up 8.41 for the year. So great start and continued strong performance from the various CTA indices that we track. Now, Moritz, I wanted to just maybe say a couple of words regarding the live event before we finish completely, or bring up any other things you want to talk about. But we do need now people to commit so we can finalize this event, because if we don't get enough participants, then we will just not do it, so to speak. And for those of you who have already signed up and paid up, don't worry, we will just refund you the money. But we want to do this event, so we want to get 10 to 12 people in the room in New York, October 26th, 27th, and really try and make some breakthroughs for you in your trading or in your business. And we have no doubt that we can deliver on that. So if you want to spend 2 days with Jerry and Moritz and myself, then please do let us know, and be prepared to commit to that so that we can make the final arrangements, because of course we have to commit on our side to do so. What else have come across your desk this week, Moritz, that you think would be relevant to bring up in this week's?
I wanted to mention the exact same thing. I'd be so happy and glad to see people in New York when we're there. I think it's going to be a lot of fun. So please reach out to us, info@toptradersunplugged, send Niels an email, and we'd be super excited to see people there.
Absolutely. I think it'll be something quite unique, and also because it's going to be in a very safe forum. Everyone is going to respect the confidentiality of what's being talked about. So not only are people going to learn from our experience, we're going to learn from each other. And this is about, really, this is about cutting off 5, maybe more years from people's journey, and speeding things up for them, whether it comes to improving the way they go about their research, their systems, or even how to go about, raising assets and growing their business. It is something we've all done and have a lot of experience with. So as Moritz said, we really do hope to see a few more people so we can wrap up the preparations for that. Anything else, Moritz, on this rainy and windy day in Denmark where I am today?
And a sunny day in Munich. So, no, but happy trading and have a great week next week, everyone.
Fantastic. On that note, we're going to wrap up this week's conversation. We hope that you enjoyed it. And of course, you are welcome to take advantage of all the free resources you can find on the website, toptradersunplugged.com. There are lots more than just the episodes that you listen to. Of course, if you feel you get any value from our conversations, one thing we really would be grateful for would be if you take 2 minutes out, go to iTunes, leave a rating and review. You have no idea how much it helps us in the rankings, and so we would be very grateful for that. I was just about to say from Jerry, Moritz, and me, but Jerry was here. For those of you who tuned in later in the show, Jerry was here for the first half an hour. So I will say from Jerry, Moritz, and me, thank you so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.